Have you ever looked at an annuity illustration and wondered, what is market value adjustment? We're going to touch on that today in episode 56 of the Atlas Annuity Podcast. Hi, everyone. This is Marty Becker, owner and founder of Atlas Financial Strategies in St. Louis, Missouri, where we specialize in safe money retirement strategies. In today's episode, we're going to address this mysterious thing called MVA, or market value adjustment. So, what is MVA? Here's the technical explanation. When an insurance company issues an annuity, they assume several risks. One risk is the chance that contract owners will want to withdraw their money from the annuity at a time when the market value of the investment backing their annuity is low or has dropped. When an insurance company issues an annuity with MVA, the contract owner may share some of that risk through the MVA. So this adjustment could increase or decrease the surrender value of your annuity only if more than the penalty-free amount is withdrawn during the surrender charge schedule. Because the insurance company and the contract owner share the risk with MVA, a higher interest rate can usually be paid on MVA annuities than other annuities that do not have MVA. Most annuities will never have less than a minimum guaranteed surrender value. If you look on an illustration, you may see a column that says MGSV, minimum guaranteed surrender value. Most annuities will never have that below 87.5% of the original premium that the annuity was funded with. Okay, so that was a lot of industry jargon. What does that mean in English? So we're going to keep it simple here. When you send your premium to an annuity company, what they're doing is they're combining that premium with thousands of other people, and they're going out and they're purchasing long-term investment grade bonds. That is what is securing the value of your annuity and why it is not affected by the stock market, because it's backed up by bonds or treasuries or a number of other safe investments. Now, if the annuity company goes out and, for example, they purchase a bond that is paying 5%, okay, so they're getting 5% through the door. If bond rates or interest rates have gone up to 6% at the time that you want to pull more money out of the annuity above your penalty-free withdrawal, you would have a negative market value adjustment. Here's what I mean. If they bought a bond paying them 5%, and now new bonds that are being issued are paying 6%, they would have to go and sell that bond at a loss to get you your money back, and they're just going to pass it on to you. Okay. Now, this could have an inverse effect as well, because if the annuity company goes out and they purchase a bond that's paying them 5%, but now new issue bond rates are at 4%, well, now the bond paying them 5 is more valuable than new bonds being issued. So this would have a positive market value adjustment on your annuity. So they sell the bonds, and any profit or gain from current interest rates at the time of that sale to get you your money back is just going to get passed on to you. And some people may be thinking that this is way too complicated. Why do they do that? It's not fair. This is no different than if you were going out and buying a bond yourself. Because if you bought a bond paying 5% and for some reason you had to get out of it, and now new bonds are paying more, you're not going to get as much face value for what you paid for it, because why would somebody buy your bond paying 5% when they could just go get a new one paying 6%? And this is the situation that a lot of people who bought bonds and treasuries like in 2019 when interest rates were really low, a lot of those bonds have lost a ton of face value. One thing to keep in mind though, market value adjustment, MVA, only applies if you surrender anything above the contractual withdrawal agreements. Okay, so basically this is, you changed your mind for some reason, you want all of the money back. This is the only time it would affect you, okay? Or if you have like a 10% withdrawal value and you say, hey, I need 20% of the account value this year, MVA could be applied to that. Now, important things to remember. What does market value adjustment not apply to? So again, any free withdrawal amount that is not subject to a withdrawal charge. So if you have a 10% penalty-free withdrawal amount, you can take out all 10% and none of this is applicable. Any death benefit paid to your beneficiaries, MVA will not be assessed against any of the remaining time value of your annuity. RMDs, requirement minimum distributions. If for some reason your RMD is above your penalty-free withdrawal amount, MVA will not be applied to it. Terminal illness and confinement waivers. This is something that's pretty much embedded into every annuity out there. God forbid you fund an annuity and 2 years later you find yourself confined to a skilled nursing facility, or you get some really bad news from your doctor that says, hey, you got 6 months to live, terminal illness. The annuity company will surrender the entire account value back to you without assessing market value adjustment, or MVA. And then, of course, income rider provisions. If you have an income rider on your annuity that is paying you a monthly amount, MVA will never be assessed to the scheduled payment that's supposed to come to you every single month. Now, if you are working with an annuity professional, an annuity expert, someone who actually knows what they're doing, this should never be an issue for you, because we always want to make sure you have plenty of money outside of the annuity and we're going into it knowing all the rules of the game. Another thing to keep in mind, if you're a regular viewer or listener, if you have an existing annuity that was funded when rates were really low, 2019, early 2020, so at least 3 years old, this is a really good time to check your minimum guaranteed surrender value to see if we can get you a better deal somewhere else with these higher rates that are being offered. And the best way to find something like that out, to see if surrendering your current annuity would be beneficial, it has to be beneficial. We have to put you in a better position. Or if you just have general questions about annuities or annuity strategies, you can reach me at atlasannuity.com and you can book a short time to get your questions answered. And if you haven't already seen my video series, 20% More Spendable Income in Retirement, that is a good place to start if you want some more information before you reach out to me. Again, everybody, short podcast this week, but anytime I start getting a consistent question on something, I know it's just time to answer that in a video or an audio format. That way, the word's out there, and I can just send this to people who had that question. So again, this is Marty Becker, episode number 56. Thank you so much for joining us. Please like, subscribe, and share the podcast. And again, wishing you all the best in your financial education, and we will see you in the next episode.
We hope you enjoyed today's episode of the Atlas Annuity Podcast. All information presented is for educational purposes only and is not a recommendation to implement any tax strategy, nor is it a recommendation to buy, sell, or transfer any security or insurance products. Atlas Financial Strategies Incorporated is an insurance-only licensed entity, and any decisions to buy or sell securities should be discussed with a licensed securities advisor, and any tax strategies should be discussed with a licensed tax professional. Past performance of any strategies or products mentioned are not a guarantee of future returns. For any other questions or concerns, please go to www.atlasannuity.com.